Singapore's sovereign wealth fund, GIC, is keeping a cautious investment stance amid increasing downside risks and subdued global growth. This comes as its key metric of investment performance remains flat for the year before at 3.4%. Cheryl Lin explains.
High valuations, slowing global growth and an uncertain future have formed a challenging investment climate for GIC. Over the 20-year period ended 31st March 2019, the fund manager generated an annualized rate of return of 3.4% above global inflation. This is the same as the year before. GIC noted that its returns have been below 4% for the past 3 years, as booming returns from the late 90s tech bubble are dropping out of the window, while post-bubble declines remain. But flat returns may be good news.
After declining for the past 3 years itself, I suppose this is encouraging that we've got, it seems like a bottoming out of the 20-year real return itself. We had expected the figure to continue to dip, primarily because it is a very challenging drop when we are looking at global equities, over that period. 3.4, very commendable in this kind of a very, very tough environment.
As for its asset allocations, holdings in nominal bonds and cash rose, which GIC says reflects a more defensive portfolio. It also trimmed its exposure in developed market equities, while investing more in emerging market equities. Such a geographical shift is strategic, says one analyst.
The valuations in America, they are almost eye-popping. But there are some very cheap markets here in Asia, and of course we have growth here in Asia. When you have a look at the rate at which the economies in Asia are growing, and you compare that with the more pedestrian rate that developed economies such as Europe, the UK, and even America is able to achieve.
Currently, investments in Asia, excluding Japan, make up 20% of GIC's portfolio. There's a good chance GIC will increase its allocation to the region if it continues growing strongly, says Chief Mr. Lim Chow Kiat. Still, he added that high growth may not always equate to good investment opportunities. And in all cases, GIC will have to practice strong price discipline. GIC maintains that it will remain cautious but open to opportunities. And since the US-China trade war doesn't seem like a short-term issue, it will look at investments that are less likely to be affected by it. That includes, for example, data centers, because the huge growth of data gathering will likely persist. Looking ahead at next year's report card, analysts say the best we can hope for is a steady market for similar returns as difficulties linger. Nevertheless, Mr. Lim said GIC's diversified portfolio and disciplined approach put it in good stead. And though GIC monitors headline issues, he emphasized that as a long-term investor, they are firmly focused on larger trends and goals.